I was selected by Goldman Sachs to participate in a 12-week course on how to grow my small business. I'm starting the sixth week today, Monday, and what I've learned is the whole emphasis is to recognize a growth opportunity within your business, to then analyze that growth opportunity, determine what you need to have to make it come to fruition, and then project what it will materialize basically to your bottom line, and then implement it. And what they're sharing with us in 90% of the cases, when you implement it, it's going to require, number one, that you gain access to capital, borrowed money, or invested money, and then number two, to hire people. So as I've gone through this and learned more about it, I realize this isn't any different than Amazon, Google, Microsoft, or Skywater. It's whatever company recognizes a growth opportunity and then implements that growth opportunity, that is going to ultimately be reflected in their stock price. So as I look at it, and I've done some research to see, I actually tracked Tesla, I tracked Amazon, I tracked Meta, and I could see, yes, they were in business. They recognized a growth opportunity. They usually went and borrowed money and then hired people. So I saw their increase in their headcount. And then almost like clockwork, 1 to 2 years later, their stock price took off, preceded by an increase in revenues. So I said to myself, okay, if I have access to all this data, past and projected data on these stocks, can I find companies that have a growth opportunity that I can recognize, get in before Mr. Wall Street recognizes it, buy the stock on the cheap, and then write it up? So with that, I I found a company through a scan by the name of Chart Industries, and I did that sort of analysis to determine, is Chart Industries a company that has a growth opportunity, that is going to participate in some new way in Chart's case, data centers and energy, both hydrogen and liquid natural gas. Are they then going to be in a position, and have they recognized this growth opportunity and this potential growth in their profits by hiring more people and increasing their debt to do more research and development? Can I then, seeing that and seeing where their price is it an opportunity for me as an investment? So with that in mind, I did this weekend some extensive research on Chart Industries, and I wrote a white paper to give me a understanding of what they do, where they fit into the big liquid natural gas industry, where they fit into the hydrogen revolution and its impact, where they fit into the data center cooling and growth industry. And then I went ahead and asked, what are the financial implications and the stock price outlook? And I did an analysis that was based on their revenue growth, their earnings per share growth, and their enterprise value based on both their current enterprise value and their 5-year multiple for enterprise value. And I came up with a prediction of what their price would be in 2024, 5, 6, 7, and 8, and how the growth would materialize. Then I created a graph or a chart that projected, based on where they are now and where they have been, what is the growth factor and what is my profits going to be. And what I want to do is make this white paper available to you so that you have a total understanding who Chart is. And you can find it on my website, Best of Us Investors. go to the icon on the top line that says articles, and you'll find it. It's probably the latest one put in, and on it you're going to see my projections and the projection of the price in the future, and then you can make your decision. Is this a stock that you want to own? But before I go, what I want to do is take you to my computer and give you an explanation of this analysis that I'm doing, so it won't be all Greek to you. And when you see this, you can pull up this part of the video again, and I'll walk you through it. So let's go to the computer so you have a total understanding of how I'm analyzing their future price based on their revenue growth and their earnings per share growth and their enterprise value. Let's take a look at it. This is my analysis of Chart Industries, GTLS. Don't know why that is, but that's what it is. We start with their revenue projections from 24 through actually 2030. And I show you the growth in their revenues on each step. Then I show you the growth of their earnings per share. This is something that the analysts create based on their earnings calls and their analysis of what the company is doing based on their earnings calls. So you can see from 2023 to 2024, their earnings actually went up 67%, projected to go up 27, 19, 4, 15, and 7. So we take those numbers and we take the current price and the current PE ratio, and we multiply the future growth of earnings in 2025 times their current PE ratio, and we come up with a price in 2025 or 2024 of $58.52, and its current price is $23.81. What this is its 5-year PE ratio. So in essence, what it's saying is over the past 5 years, the PE ratio was 29.2, and if we multiply the earnings of $12.92 times the 29.2, we get 377 rather than the 5 or the 158.52. So this is a decision that then you as a stock purchaser have to decide: do I want to base my projection of the future price on its current PE ratio or its 5-year average? Why is it down so much? We'll look at that in a second and come to an understanding. In essence, it's a depressed stock. So then we do that same mathematics all the way across, and as we go out to 2027, we're projecting the price will go from 123.88 to either a conservative at 12.26 PE ratio to 26.93, or its 5-year PE ratio at $540.94. So that's the logic of that. Then we go and we say, what's its enterprise value? What's an enterprise value? If you decided that you wanted to go buy out all the stockholders of Chart and take their cash, and what would you realistically have to pay for that company based on its current values? You would pay, what is that, 100,000 million, $10 billion, $189 for the company. That's its enterprise value. So then what we do is we say, what is the current price relative to its enterprise value? And what we come up with is that its price, the 10.1 billion, is 2.3 times their current earnings. Okay? Their enterprise value is 2.3 times their current revenue. Okay? So now we say if their revenue is going up 12%, what's their enterprise value? Again, multiplied by 2.3. And then we equate that to its current price. And that says that multiplying its growth in revenue of 12% its current price will grow accordingly. Now, what this line down here is its implied earnings value. And what that is again, it's measuring it not on its current multiple of earnings ratio, but its 5-year average. So here we have a 2.3 multiple going to a 3.9. Well, that then directly reflects in its anticipated price. So we have good scenario, bad scenario, good scenario, bad scenario. And then what I've done is taken all 4 of these prices, whether it be at the 12.2 PE ratio or the 29.2, whether it be at the 2.3 multiple of enterprise value or 3.9, and then I add them together, divide by 4, and that's what I come up with. So, and again, is it real important that we get it perfect? No, because reality says we're doing well if it stays on the lowest possible projection of 188, but we're taking into consideration that 188 could turn into 449, or it could turn into 271, or it could turn into 462. You can see these two are pretty close together. These are still part. We divide that by 4, and that's the price we see. This is 2024, this is 2025, this is 2026, and 2027. So based on this, I say, this sounds like a good investment, a good opportunity. And if you'll read the white paper, you'll recognize why it is, why their products are being put into data centers, why they are the leaders in the conversion from oil to liquid natural gas, and possibly hydrogen. If you'll read that report, you'll say, I understand. I see the growth opportunity. Now I want to show you something else that I do. This is a chart that I put together recognizing that companies grow based on growth opportunities. You can look at even Google and Amazon and Meta. The reason they're buying GPUs, spending money, and hiring personnel that can help them put those GPUs into a monetized position, why they're doing that is that's a growth opportunity. Well, that's what GTS or chart is doing. So what brought me to this initially was the projected growth in their revenues that I saw, the projected growth in their earnings per share, but what really kicked in was their head count. Their head count grew over the last 2 years by 125%. That said to me, these 3 numbers said to me, and the growth of their debt, I need to dig into this company. I need to understand it better, and then I need to do the price projection analysis. So what I do is these are some other companies that I am analyzing to create this chart of growth potential so that I can spot the growth opportunities in the stock market. I know about Amazon. I know about Google. I know about Meta. I understand that entirely. I understand NVIDIA. And I believe they will give me a consistent, over the next 3 to 5 years, 35 to 40% return. But I believe that chart's going to give me 141 between now and 2027, 226% rate of return. And I can make it, I can get in and out as I see that, well, maybe I want to take my money somewhere else because they're only projecting here a 9% growth in earnings per share, then a 6. Maybe I can find something better, and maybe it's in these over here. That's what I do. Again, I want to emphasize the bulk of my portfolio is going to be in the big tech, where I can get historically 31 to 35% rates of return. But then I need to take what Goldman Sachs has taught me, that the stocks that grow exponentially are the companies that recognize a growth opportunity, study that growth opportunity, implement it, hire the people to make it happen, and they get the 200 rate returns per year. That's how it works, okay? If you want to see more of this, I invite you to join our tribe. Right now, you can get access to all of this on my cheat sheet for the ridiculous price of $19.99, okay? If I can't make you $20 a month with this kind of analysis, because what you need to understand, this is what Goldman Sachs and BlackRock and JP Morgan have been doing for the last 20 years. But that data, this data that you see here on this screen was not available to me 3 years ago because the internet wasn't publishing it. I now have subscribed to services so that I can gather this. What I'm doing now is hiring people to fill those boxes automatically every day. Anytime the price changes, the PE ratio changes, the enterprise value changes, those boxes change. And that will all be on my cheat sheet. And you will have access to it. What does that make you? I think it makes you as good as Goldman Sachs. I think it makes you as good as JP Morgan or any hedge fund. This is what they've been doing to kick your butt for the last 200 years. Nah, that's not right. The stock market wasn't around in 1700. I don't think it was. So I want to make this available to you. Come to the website. First, read the white paper. Understand the science, okay? The financial gathering of prices. I don't care what the market does tomorrow or Wednesday or Friday. I want to know what chart is going to be worth on January the 1st, 2027. And I believe it's going to be somewhere around $366, which would be what, a 3x from where it is today. I'm Kerry Grinkmeyer. I'm a retired financial advisor. I don't have anything better to do. So if you want to benefit from my knowledge, my experience, and my money, because I'm paying people to fill these charts automatically. And then I got Goldman Sachs on my side. How can I lose? Talk to you again in the future. I'm going to do fewer and fewer videos because I'm doing more and more research to help you make more money.